sorry, we got interrupted there. So Des, you were saying about the gold price. The S&P 500's gone up 125%, whereas the gold price has gone up only by 25%.
25%. And I think what is most interesting is that since the gold price peaked, that was in early August 2020, at peaked, I think, at $2,070 an ounce. It's come back now to about 1820. That's a decline of 12%. In the exact same period, the S&P index has gone up 46%.
Sure.
So there's been a huge divergence of these two investment avenues.
But is that a factor of the Fed continuing to print money and keeping?
I think a big driver, and it's very much supported by very strong economic numbers out of the US, which have continued right up until now. Companies have reported excellent results, and we're going to see the quarterly reports coming out soon. That's going to be, I think, very important.
Yeah, because why would you want to invest in gold, which doesn't earn a dividend, you get no yield from, when you can rather buy equities where you can get a yield from, a real dividend?
My concern is these equities, we've got a bubble. And the bubble, to me, we've got people involved in markets that I think, due respect to them, I think there are a lot of people involved in markets today who have got very limited fundamental knowledge and are basically have just run on the back of what has been a very pronounced uptrend.
The so-called Reddit crowd.
It's a crowd. It's a crowded trade. And I'm just wondering if we don't start to see factors creeping in, which will start to unravel all this. What's most concerning is the level of debt. Debt is extraordinarily high worldwide. Government, if you look at economies in relation to the amount of debt that's been created, that's where I think there is certainly a big risk factor. Another factor, I think, is China. China is unlikely to be the driving force of the world economy as it has been over the last couple of years. A lot of things have happened in China on the property side, on the banking side, and those things, I think, are being underestimated. The problems are being underestimated by the markets.
Yeah, I think last year that is probably one of the key features in 2021 was the new regulations out of China and the Chinese government cracking down on the tech sector, the education sector, and I think that really caught the market by surprise. They thought China was a real free market economy, but maybe not so much.
You look at the Chinese internet shares. I was just looking at it the other day. These shares over the last 11 or 12 months have come down by, the index has fallen by 65%. Who would have ever thought that could happen? Now, I'm just wondering, I'm not suggesting that other markets are going to fall by 65%, but what happens if markets come back 25, 30% and maybe more as we start to unravel all this excessive speculation that's taken place?
Yeah,
I would think during that period, I'll be very surprised if gold doesn't attract money again.
Yeah, I guess that would make sense. I mean, I think that is definitely a concern, because the main driver behind this, the stock market performance over the last 2 years or so has been the cheap money and the Fed's actions. Now, if that's going to change, it would be difficult to see how these valuations could stay where they are. But having said that, I did see a report not so long ago saying that when interest rates are relatively high, the stock market actually does perform well. And I think the reason for that is that the interest rates are high because they're trying to combat inflation. And generally speaking, in a normal scenario, this is maybe a different scenario, but in a normal scenario, you have inflation because the economy is pumping. And if the economy is pumping, it means that companies are doing well and they're making a lot of money, and that filters through to dividends, etc., which pushes the prices up. So it'll be interesting to see how things play out. Also, they say in another report I read that when interest rates are higher, in a high interest rate environment, typically things like commodity prices, natural resources, and gold perform well. They outperform other asset classes.
Well, we've had a very, very good resource market. I think these share prices have moved to very high levels again. And I use a technical indicator which tells me, I try and measure the heat in the market. And what I often do is I look at how a share price deviates from its long-term moving average on the upside and on the downside. And it's most interesting to see how far equities, particularly the more popular ones, have deviated on the upside from their long-term moving averages. And what I've seen over the years, share prices ultimately come back to where the moving averages are. And really, it's telling me that be careful, share prices have diverged massively from long-term moving averages, telling me that it is hot in the kitchen.
Yeah, absolutely. But I think we need to, when we say it's hot in the kitchen, it's also in certain areas. So I think it's very hot in the tech sector, especially in the US.
Absolutely.
And maybe even things like Bitcoin, etc. That's where it's very, very hot. But maybe in other sectors, maybe not as hot. You mentioned the Chinese
internet.
The Chinese internet is way, way underperformed the US tech sector by a huge margin because of the crackdown in regulation in China. So it'll be interesting to see if that sort of normalizes and things like Alibaba and Tencent in China and feeding through locally to Naspers and Prosus on our exchange might perform well this year relative to the likes of Apple and Facebook, etc.
Yes, I'm pleased you're mentioning Apple and Facebook. I'm just suggesting, not that I know if things will change, but what would happen to their share prices if they had to announce some disappointing results, when everybody is believing this effectively it's a free ride. And we've seen before companies that are basically producing outstanding numbers, suddenly something does go wrong or disappoint, never mind going wrong, just report disappointing numbers. Those share prices could unravel in quite a major way.
Absolutely. And it's quite interesting, we've already seen, it's only been 2 weeks of the year so far, but I've noticed we've already seen a bit of a pullback in some of the tech stocks overseas, and a sector rotation, as they call it,
yes,
from tech stocks into commodities, natural resources.
Or value plays. Value plays which have been very much out of favour. We've seen very recently a typical value play was British American Tobacco, where the stock was really completely out of favour, and in the last couple of months I see it's improved by 30%. A stock where people thought, well, it's involved in smoking and that's a taboo area to be. And meantime, the share price, because of the very cheap area that it got down to, has now rallied by 30%. That has certainly come as a huge surprise to many people. And I think that's just an example of the money, what you mentioning, money moving away from areas that are hyped into areas that have been left alone.
Absolutely. And I would expect that to possibly continue for at least for the next few months, out of the very hot tech sector into other sectors that haven't done so well. And or maybe I still think the virus is going to have a major effect on the way the markets play out. So, for example, a local stock like SPAR was hit very negatively in November after their results came out, and also concerns about the virus continuing to limit sales of alcohol and things like that. But if the what we've seen so far, it looks like again that this Omicron variant is less deadly than the other variants. So that may lead to things opening up again, and some of these stocks that have been beaten down specifically because of the virus might start to recover again. Travel and leisure, hotels, airlines, those type of stocks.
No, there's going to be certainly opportunities, certainly on a relative basis. Yes. I think some of the cheaper shares, we just mentioned British American Tobacco, some of the cheaper shares have already enjoyed some kind of recovery off very depressed levels. And maybe if markets, which are the most important markets, break on the downside, some of these shares may pull back again, and one may have a second chance in buying these shares at very attractive levels.
Yeah, and I think
That would be my focus, to look at equities that basically come off as a result of an overall stock market decline.
absolutely. I think that would present quite a nice opportunity.
Would be really a great opportunity.
Yeah, absolutely. Yeah, and that's great, Des. Thank you. Is there anything else you'd like to chat about?
No, I think that we've got to watch very carefully. I think the next couple of months are going to be very, very interesting indeed. And I think people who've been waiting on the sidelines with cash, I think they're going to be in a very strong position to look at attractive buying opportunities as markets weaken again.
Yeah, absolutely. And I think that's just a standard thing, as share prices come off and go so low, or maybe get overstretched to the downside.
Absolutely.
That always presents an opportunity to buy. If you're a value player, and if you're a momentum player, I suppose you can follow the trend, but you can't hold on to it for too long, because things might turn around.
Absolutely.
Yeah. Well, thank you, Des. I really
Great
appreciate
pleasure.
your time. That is great, chatting about the markets again.
Lovely.
And we'll definitely do it again sometime. And to you all out there, good luck on the markets. If you'd like to talk about the markets, you're welcome to give me a call, or drop me an email at warrens@afrifocus.co.za. And we'll see you soon. Thanks.